Ladies and gentlemen of the crypto space, it's a Monday, May 13th at 11:31 a.m. There's a hell of a lot of stuff going on as always, and as I talk on Discord and I talk on social media on X and whatnot, thoughts come to my mind. Very simple thought is what do we do, why do we do it, and how do we do it? And I often think of who my mindset most closely aligns with. And everyone says they want to be the next Buffett. I am in no way saying that. What I clearly state is that I understand his core investment thesis as expressed by the amount of actions he takes, the time he takes, the prudence and diligence he takes. And it's not even necessarily his. It's a very reductionist perspective on how to manage capital. And it's something that I've honed in on very precisely as how I want to proceed into the future. Simple. Passive to a degree. Let the companies that we own operate unto themselves, but we're a shareholder of sorts, and we want to be a strong shareholder. Depending on how much capital you have, can you be a majority shareholder? You need a fair amount of capital, but you don't need to be, especially considering the landscape of cryptocurrencies and the exposure that these businesses offer to investors, not being anything comparable to the offerings of more traditional investments. Equities. Equities are very much not made available to the general public. You see different classes of shares with different voting rights, and it's really the very wealthy that have a capacity to acquire majority ownership, which can affect day-to-day operations, including their capacity to extract capital vis-a-vis revenue. And that's something that smaller actors are capable of achieving in crypto markets. So it's something that we are able to entertain, at least to a greater extent than anything that's achievable in stock markets around the world. With a reduced risk profile is something that I'll continue to argue. Immutable, deterministic contracts for reducing the risk profile. Anyway, the imagery is of me as Charlie and Buffett's next to me, so I guess I like to think that I want to do something similar to these gentlemen. I have no expectations. We speak very frequently about the notion of expectations, and my expectations are extremely humble. My expectation is to adhere to my investment methodology. Everything that comes of that is just a manifestation of my capacity to strictly adhere to my investment methodology. It's as simple as that. You are playing against yourself, seeing how well you can execute according to your rules. And that's as any enterprise or any strictly defined instrument, such as a trust, for instance. You want to define the rules rigorously and strictly adhere to them. And then whatever happens into the future is a manifestation of exactly what you did and how prudent you were, how restrained you were, so on and so forth. Okay. So the title is Distressed Assets, and that's probably at the core of what Buffett would have liked to do with regard to methodology, and he was probably over the years pushed out of his comfort zone, and I believe that is the case with regard to Charlie and what he encouraged, and those are reasonable things to draw on with regard to how do you want to behave as an investor? What kind of rules do you want to define? And I appreciate the core methodology of that I will describe. And it's very simple. Distressed assets. What is a distressed asset? It's an asset that's representative of a business. You want to own a business that is productive, that serves economic purpose, that offers products and services that consumers are consuming. And what you want to optimally identify is mispricing. You're not going to really have a distressed asset in crypto markets. What's the debt load of various protocols that are immutably deployed and deterministic in execution? There's no debt load. You have risks. There's always risk evaluation. But a distressed asset is probably best said from the perception of market actors. You know thy peers was probably the last stream's title. Know thy peers, and they could easily misprice an asset relative to what its value is, and that is your responsibility as an investor to determine what is the value. And if the value doesn't match the price, it's mispriced. Pretty simple. So we open up on the DXY to emphasize that we're a very macroeconomic oriented conversation, but we could show some charts to be specific. So obviously I have my 4 velodrome, arrow, and kingdom related assets that I have interest in. And we could talk specifically. Why not? I have a way of talking specifically in a constructive fashion that is not negative at all onto a protocol with regard to its business offering. We're generally probably trying to talk in the best of light, know thy peers. And probably the best representation of that is Aerodrome. Chart is obviously getting a little dated. I can move things over, but whatever. Okay, so Aerodrome. Base. It's a big deal. So the statement probably was made on the way up. You're like, I want to own this. Why would that statement change? You want to probably have exposure to this. You need to understand what is the opportune time to have exposure. You have to understand what are the expectations of having exposure. And they're nuanced and very specific. And they're not like other assets. I made a post, I believe, over the weekend discussing VE and VE33, particularly with regard to expectations. Posts are very critical about emissions. Okay, it's designed to depreciate. It's a bifurcated incentive system. Deficit spending is used to finance liquidity depth, which drives capital into LP positions, and revenue from transaction fees is solely directed towards locked positions, bifurcated incentives, which means it's designed to go down in price. Now, that is going to be very counterintuitive to thy peers that buy things to go up in price. And you can obviously invest in things that are structurally set up to go up in price via technical analysis, via some sort of other more higher level observation, capital flows, order books, or a narrative that's going to catch a bid and draw in capital. But it's important to be granular with your inspection of these types of assets. And what I've loved to do over the years is be contrarian and look at person's opinion and not even pick them apart, but understand that they're entirely missing the point. So one of the most interesting observations about VE and VE33, it's designed to go down in price. Okay, so what does that mean? A good observation is, why is it not going down in price? Now, clearly, it's going down in price from top. Where is a level that it finds consolidation support? That's an interesting presentation from a technical perspective. Where do we see things like that? We look at maybe most recently Ramsey's, potentially a support at this technical level. That'd be intriguing. Maybe there's a support all the way at the bottom. Look at Clio, complete retrace down to the bottom. Now, bear in mind, if you get a break of structure where there is no floor, there is no support, that is reason for potential invalidation of narrative, and something that is not according to your analysis, something that is not correct. You're missing something, which does introduce significant complexity when evaluating investment opportunities. This may be indicative of not just a Cleopatra level observation, but maybe a mantle type of observation, something going on with the state of the network and the potential for it to attract capital flows or for capital flows to be driven in because of opportunity on the network. Could indicate stagnance of the network, and that is a potential investment risk. That is something that is very important to be respective of. Now, here's an interesting consolidation. Look at the price action between 382 and 236. Now, it's not necessarily a level until it forms a level from a technical perspective, and that takes time, and this is on the 4-hour chart. What kind of short term, low time frame, drive yourself nuts. So, this could be a level. 236, there was some consolidation back here. Let's see if it's a level. And that would be interesting from a technical perspective for an asset that's designed to go down. It's designed to go down as long as the amount of revenue potential on the locking side is a no-brainer. Because if you buy a position that's producing 50% APR and the principal depreciates, but volume on the network remains relatively constant, you're still making the 50% on your basis. As the price depreciates, your variable APR will go up, proportional or respecting a constant volume of transactions on the network, which means basically your APR is constant relative to your basis. So it's deceptive, and that's why I talk in terms of perpetuity, the lock that's offered. It's actually a very interesting perpetuity because it's a technological perpetuity, which gets intriguing with regard to entity precedents. So from that perspective, you are not purchasing an investment that is being capitalized on by price volatility. You are purchasing cash flow, and you are aligning yourself with the potential activity in a market. Do you want exposure to a particular market and the actors on that market that are doing whatever they're doing, either speculating on price action or engaging in cross-currency, FX swaps, maybe they're doing some sort of settlement, and they're on this particular market, this is their market of choice, it's irrelevant. That's the point of this people's banking infrastructure, that this is that, and just that. You are providing infrastructure to facilitate cross-currency exchange, FX markets, where you get swapped from one denomination to another. And this is the type of infrastructure that's required for it, except this is actually quite intriguing infrastructure, not Nile in particular. I'm talking about VE and VE33, particularly because of the bifurcated incentives idea. Now, historically speaking, none of this has any precedence. Incentives, general public involved in liquidity provisioning and facilitation of cross-currency swaps. Some precedented in under almost all inspections, so that's intriguing to say the least. So, this is a topic we talk about often. Clearly, this is a particular asset class that's of interest to me for many reasons, and it's not necessarily because I expect it to appreciate. I expect performance and these networks to garner a lot of interest. I expect the volume on these networks to vary over time, go down, go up, go left, go right, but trend upward in a secular fashion. Therefore, my expectation is not principal appreciation in any regard. In fact, I consider the fair market value of these particular positions to be effectively zero. How about that one? Which is why I often say a purchase, not a position. And the entire business operation is from a cash flow inspection standpoint. Best set of cash flow accounting standpoint. How much are they generating? Account for it. Tabulate it. Pick your software. and accumulate capital, reserves, such that you could acquire additional position in existingly owned business, opportunistically at distressed prices. Identifying mispricing, misunderstanding, as a result of knowing thy peers to completely have no idea what the fuck this stuff is. These are the most hated assets in the entire crypto space. And the fact that Aerodrome was the beloved asset of Base, bear with me, sneeze, was almost assuredly to be transitory, given that the emissions rate is going to drive down the price. So for quite some time, folks expected it to keep going up. And the last thing you should expect is something that's going up to continue to go up and not experience any cyclicality whatsoever. And clearly this chart is expressing the reality, especially of these deficit spending businesses. They're designed to go up and go down. Dare we look at like Curve and Aura and Balancer that are very range bound. I don't think I have a Balancer chart. Maybe I have an Aura chart. Let's see if I have one. I haven't even been following it, is what it is. And it's towards the bottom of the range, especially Curve. It's literally just at the bottom, but then you could discuss, and you get your complete bias because of the hyperinflationary decay upon inception. So if you go something like this, you get to see where we are. So expect it. What's the expectation for an asset's price action like this? Up, down, wherever the hell it goes, it'll come back down, and maybe higher lows and higher highs over time. But these cycles are going to play out in years. So we have a clear expectation. We have a clear market that we're gaining exposure to with regard to cash flow. And those are all important observations. In fact, distressed asset pricing, this is probably the case where Curve is actually most interesting from a distressed asset price, considering it's at the lows. Now, barring invalidation of the narrative and just continued driving down of the price to the point where there's some sort of systemic, quote-unquote, insolvency that just collapses price and is very destructive and disruptive, if not obliterating all normalcy, and could potentially even invalidate the entire currency significance. I mean, down to zero. If no one holds an asset, it's worth zero. But history and hindsight are fascinating. Maybe the asset price has a significant liquidation. It's driven down to 5, but that doesn't make any sense, because as the asset price goes down, if the volume on the network is still strong, that means your revenue for lockers goes up, up, and up because you're able to acquire increasing position size at the depreciated price. Who's not going to buy 200% APR? I mean, if you're at 40% APR, give or take, for a lock position on Curve and greater on other locking protocols, 37%, if the asset price gets cut in half, you got a 72% APR, proportional to network volume, network activity. So it becomes increasingly attractive as price depreciates. So these are the forces involved in these particular assets. At minimum, you have to understand what you're talking about before being excessively critical. It's not designed to go up because of emissions, deficit spending, so it's designed to go down. So what forces counter depreciative effects of dilution? All right? So instead of the bandwagon where, oh, the price goes down, and just knowing thy peers and their novice capacity to inspect something that's potentially novel in many regards, maybe have a different perspective and see why and how something can work rather than why and how something's just going to fail. And that's the perspective that I have, and why I've identified these particular assets as I say, as being extraordinarily novel and intriguing, to say the least. And from A reductionist perspective, the Buffett mentality, just buy it as cheap as frickin' possible. You want to buy it at the bottom. I mean, that's kind of the same thing as engaging in market activity for price speculation. And it's the same thing. So buy it as frickin' cheap as possible. But you have to know your expectations. Clearly, if you're running around with a $100 portfolio, you ain't going to get shit on 50% APR, making $50 a year. But that's something for you to define. Exercise your fiduciary responsibilities. There is certainly a threshold in which you can and cannot engage in this kind of activity. And that's subjective. Each and every one of you have to define that threshold. Maybe it's $10,000 and you get 40% of the money, you're making $4,000 a year. Holy shit. It's a very interesting threshold. And that will surely be subjective. So the most important thing is respect your fiduciary responsibilities and define these things. Write them down if you have to, if you have that requirement. Just do that. And you'll be able to do better over time. If you're on X or YouTube, please feel welcome to post any comments or questions, and I will get to every single comment or question before ending the stream. Thank you for joining. 164 people on the stream on a Monday afternoon. Pretty nice out here in South Florida. Hope it's nice where you are. Raoul's in the house. Sir Joe present and accounted for. Frank Morning, Noah. Joe, rather than planning entry on Arrow, you can LP with USDC with a hedge against downside price action and provide higher returns. Okay, so there's countless ways to engage with markets from a perspective of financial returns. What matters is understanding the risk profile and making sure your expectations are in line with reality and establishing these rules and sticking to them. In the end, you are playing a one-person game against yourself. There is no such thing as community, and if engaging with the market, such as literally GameStop that's rebirthing as a community, once it goes all the way up and then it starts to sell, no community. It's you sold for whatever price you sold at, and you capitalized as much as you capitalized. Financials, unfortunately, are a one-player game, and it's never personal. It's just business. Hope that helps. Nice observation, Joe. And of course, there's the other side of the engagement with the business. Obviously, there's the revenue, which has relatively low expectation for price appreciation. And the greatest expectation is hopefully a continuity of cash flow and an increase in cash flow over time proportional to the increase in network activity that's speculated associated with the secular nature of the market. Hope that helps. I believe given Aura's price is around 85% APR currently, crazy if you think about it, well, that is why price has found potentially a bottom. I think it's 35 cents or whatever the heck it is. I used to have a chart for it. I think it's in the 30s. I don't even know what it's pulling up. Solana shit. Or V2? 62 cents. So liquidity. I don't even know. I need balancer. Oh, here. Or W. 65 cents. Literally had to search for the chart because it's balancer data because that's where the liquidity is. Okay. Lower highs, lower lows. This is going back to Q4 2023. This particular OP, 3.1 mil in liquidity. That's pretty interesting. So this is a decent chart for inspection. Okay. So if in Q4 2024, Q1, Q2 2025, this is a structural cyclical bottom that contributes to a secular higher low, where the next higher low is, $1.40 after running to $5. Okay, then you're starting to see a bigger picture on how these assets behave. 85% APR is quite attractive. And that's clearly contributing to the fact that there was a bump off the bottom here at 57 cents. That is my speculation. In the next 4 to 8 years, we will see consolidation towards some sort of highly critical return on capital expectation. That, that's interesting. That's very comparable to like uh, what's it called? Or just like just being compensated for risk. And then if you're like 5% rate of return on risk free, if you're going into like municipal debt or distressed corporate debt, you're wanting large percentages of return to compensate you for the risk that you're taking. Now, 85%, holy shit, that's a lot of compensation because likely there's a fair amount of risk. That's the risk, and risk is always dependent on interpretation, comfort, understanding the volatility, understanding the technology, understanding the nature of the investment. So maybe it isn't a great deal of risk. It's all relative. So that's a lot of return, 85%. So that's quite tempting. Why the price bounced off the bottom here? And we'll see what it does. Do not speculate on the price action of a VE or VE33 asset, especially to the upside. What you're inspecting and speculating on is where you are relative to an interesting price of acquisition, a potential floor. You're inspecting the bottom rather than the top. And the bottom is much more interesting and informative and useful from a capital management standpoint than the top. Buying opportunities, of which I don't see too many in the market, especially all things considered from a macroeconomic landscape. We're not quite there yet. And that's exactly why I opened the stream with the DXY. Still not there. It's going to take time. It's literally May. I mean, we're not there yet. I'm not going to digress into macro unless someone asks. I believe, given Aura's price, I hit that question. What a great thumbnail. It's Charlie, who thinks crypto's rat poison. But so many folks are so critical of crypto for what's its use case other than avoiding taxes and fraud and whatever. And I'm like, all right, remittance, cross-border FX, transactions, settlement, general public providing liquidity, crowdsource liquidity. With an example that if you give money to Chase to make a market between dollars and euros, wanting transaction fees, there's no such thing as a capacity to capitalize in such a fashion. The banks provide the liquidity. The banks, that's their business. But if you want to provide liquidity, you cannot. But in this people's banking infrastructure, that's exactly what we're talking about. The provisioning of liquidity, the bifurcation of incentive systems, monetary policies. These systems are doing what traditional finance does, except offering access, which is ultimately investment opportunity to persons that see a potential opportunity for what it is. So yes, it's a good thumbnail. I'm no Buffett, but I sure as hell love the simplicity in his core thesis of how to engage with markets. Geld's in the house. Pleasure. Good morning, Cap. Y curve paying 48%, roughly 40% APR those prices, with YCRVB2 around the corner. Why aren't you buying some? I'm done with investments. I have capital expenditures. I have liabilities I need to settle. I have things I need to take care of, and I've acquired everything I need to heading into the cycle, the coming currency expansion cycle. On our path of this new secular trend, this new world that we're in. I have more than enough assets and more than enough exposure to markets that I found interesting. In fact, I have a little excessive exposure, but that's okay. I know I'll feel a little bit of pain economically because of my choice to have excessive exposure and not exercise maximum prudence, finding the most incredible discount possible. But that's okay. Sure as hell think about it and understand that I needed to wait until you see the tears in people's eyes. And that's a horrible thing, but that's exactly what everyone talks about with regard to blood in the street. Listen, you want to buy Arrow, you're going to get a price of 25 cents or less. Sorry. And if I don't get to buy it at that price, that's okay. Either get the price that you want slash need, or don't fucking buy it. Isn't that kind of simple? Now, I understand so many potential counter-arguments. Thy peers would say, this is the most incredible thing. I'm going all in at $1.80. That doesn't really work, does it? So, it's not a competition between one another. It's not, oh, I went in and I got made 1,000 extra on the money and I'm flying private jets and what. All right, great, good for you, dude. So, one-player game against yourself to be able to sleep at night, be comfortable, and meet your expectations, yours and yours alone. Don't compare. Execute and measure your success relative to your expectations and how well you followed your damn rules. So, yeah, mentioned 48% on Y curve. Cool. Core of the portfolio. So my rationale, how I would respond is, that's the core of my portfolio already. I need no additional exposure. I would it's hard to turn down a blatant opportunity. For instance, if I could acquire a VE Aero NFT at, I don't even know if I'd buy it 25 cents. 25 cents or less, and it's starting to, you can't deny it. 25 cents or less, and you're like, is this the level? I mean, that was full retrace after a mega magnitude of a move. So that's got to be interesting, because just because the price went up and down, nothing changed with the base narrative and the coin-based narrative and the user inflow narrative and the total stable coins on chain and the TVL, but more so the stable coins that are available on base. It's a lot of stable coins. And I think that's quite interesting. So now, and this is exactly what everyone talks about, now that the price is cheap, that's exactly what I'm interested. And folks always say, you love Bitcoin at 60K. Why didn't you buy it when it dipped to 16? That's exactly, nope, that's the portfolio. And Bitcoin, so so if you apply this thesis that we just talked about to Bitcoin, it's like, you love Bitcoin. It changes the world. It's sound money. Bitcoin fixes that. And Bitcoin was 16, 15.5, and you didn't buy it? Oh, you're afraid it was going to go down lower. That's not part of the investment rules. The rules are simple. If you have a thesis around a type of asset class that you want to own, and I choose productive assets with cash flow for a variety of purposes. Maybe you choose Bitcoin. Why did you buy it at 15.5? And that's what everyone says. Buy when it's cheap, sell when it's high. That whole fear thing is a problem. Y'all got to fix that fear thing. Fear has no business in capital management. What matters is rules and executing strictly. And your success has nothing to do with the amount of capital that you earn, the amount of financial gains you experience. Your success needs to be measured specifically and only how well you're executing your rules. So if you are a Bitcoin investor and you did not buy Bitcoin at 15 and change, you should adjust your rules. You missed something that was meaningful. That's exactly why we're talking about something like this. You see something at 25 cents or less, you're looking. Oh, maybe there's an NFT that comes up at 16 cents. Okay. Now you're talking. 15 cents. Oh, someone's desperate and they're liquidating at 10 cents. They're desperate. Blood in the streets. The bottom, support. Fear in the market. Distressed assets. The narrative didn't change. All that shit about people going all in at $1.80, the narrative never changed just because the price is down. Price is down because of the mechanics of the asset and knowing thy peers having zero understanding that the price is supposed to go down. It's also not supposed to go up significantly. It's supposed to be suppressed price upside and supported price downside. manifesting from the bifurcation of incentives. Hope that helps. Let's keep it going. Ben Cohen thinks BTC dominance continues upward and no altcoin until rate cuts. I don't know why rate cuts has anything to do with it. Bitcoin dominance, let's take a look for the fun of it. He's been right the entire time. He's done very well from a capital gains perspective. He's clearly not an investor, at least in the sense that we discuss. Structurally, let's go out even further. Structurally, there is a potential expression of resistance, at least historically speaking. And suffice it to say, this chart expresses it's a completely different world. You're not up at 70%, like in 2021. Not getting up there. It's a different world, different composition of the markets. And you draw the technical lines you want, but in fact, I drew little green circles. Like that magically means something. So this is probably where you're at. Maybe get to 60%. And that's probably like this trend line. For the fun of it, that's probably what everyone's going on. Let's get a little trend line going on over there. Let me go from like here to here. Ooh, I make a line on a chart. Ooh, it's some big stuff. Boop, 60%. Oh, the 60. Gives a shit if it goes to 60%. All right, great. Time for what? For asset prices to go up? This chart means nothing with regard to volume, activity. That kind of information, you're looking at on-chain data. You're looking at, I don't even know where I put it anymore. You're looking at DeFi Llama, you're looking at stablecoins, now looking at TVL, you're looking at stablecoins on respective networks, and probably even more so, you're just looking at macroeconomic data. I don't see the significance of the way I've encouraged us to think about Bitcoin as a cash, not as an investment. So that's interesting that Ben says that. Tay Pusher, and I'm just trying to respond in the context of how I think of markets, and it's cool. I don't. Maybe there's more discounts, more distressed assets. I think that maybe is the only manifestation of Bitcoin dominance increasing. So the primary difference between Bitcoin and alts, as people call them, is Bitcoin is probably the soundest money on the planet. And I'll sound like a Bitcoin maximalist when I talk about Bitcoin because I am in regards a Bitcoin maximalist. And I think just the vast majority of Bitcoin maximalists don't really understand financials because I, being a Bitcoin maximalist, and also talking about investing. What are my preferred investments? Investments produce income. Income gets accumulated for reinvestment purposes, and income gets stored in varying denominations. So you could vary your cash on hand between different international currency choices, Bitcoin, Ethereum, gas tokens, what have you. They're a transitory destination for investment purposes. But investment purposes, the critical attribute of investments are that they are in productive enterprise that produce cash flow based on offering a product and or a service. Cash and investments. Hope that helps. Also thought on a carry trade of CRV-USD using LlamaLand. What happens if there was an automated vault that does that? DeFi Saver does interesting things like that. You get some nice leverage in there. DeFi Saver has been around a long time. DeFi Saver. There you go. There's your automated vaults. I'm not going to look through it, but in fact, I have LlamaLand up, so that's cool. Hope that helps. Market will be affected. You won't notice a thing. This is all microscopic. Curve is microscopic. The L2s are microscopic. I mean, mainnet's got. So sometimes folks need that contextual perspective. And we're going to go over to stables for that. $80 billion on Ethereum mainnet. In the grand scheme of things in the planet, that's zero. Zero. All is $160 billion. In the grand schemes of everything, that is zero. You wouldn't even see it on a chart. It doesn't register. So, food for thought on where we are from an opportunity standpoint. I think it's only just beginning. And all we need is interest rate arbitrage, geopolitical, geographic arbitrage, regulatory arbitrage. That does the rest. Thoughts on Aerovelo, unlimited token supply? I hope they're unlimited. I would hope they're decaying emissions, disinflationary emissions. They should be unlimited. That's the whole point. It should always be a depreciative pressure in the market, balanced with an appreciative pressure associated with the volume on the network, driving cash flow to lockers, and that's the incentive for that behavior. A bifurcated incentive system. So that's the biggest shortcoming, is the general public, thy peers, thinks in terms of this very 2017 conversation of, oh, emissions, inflation bad, sound money good. Well, that's not the way humanity works. Humanity works with experimentation and seeing what actually works in a cultural, societal way. And a lot of that has to do with what's adopted, what's chosen, what's accepted, what's asked for. And frankly, incentives are something I've discussed to a great extent. Some of the most important thing in all of finance is, what is the damn incentive? So that's a good reason why I look at these types of businesses, because they are novel businesses, not novel financial businesses that are dealing with incentives in a novel way. Quite intriguing, to say the least. They're supposed to be unlimited. There's nothing wrong with unlimited. It's not about price appreciation. If you're looking at goddamn arrow for price appreciation, this is what happens. And it was always meant to happen. You're looking at the wrong asset, broski. Need to be looking at dog food butt plug coin. Fuck. Know your asset class. Meme coins, businesses, sound money tokenomics, if that's your thing. That's obviously cool for cash. Bitcoin's meant for a cash position. And gas tokens, and it's just deep pin, of course. There's a lot of revenue potentially there, but bet XYZ the shit out of your favorite deep pin protocol or DA protocol. How much does it cost? How much is it paying? And how likely is it to continue paying into the future? Otherwise, you're not an investor. You're literally just along for the ride. Can you look at curve TVL across time? Why did it fall significantly more than Uniswap's last epoch? Market actors chose to move their liquidity to other places, maybe capital flows out of the market, maybe capital flows to wherever. Capital flows from underperformance to outperformance. Capital flows from lack of opportunity to opportunity. Incentives affect and drive capital flows because they alter the opportunity calculation. Why is going to drive you nuts? The fact is what happened and what did occur. And that's all that matters. It's just something that reminds me of software engineering. It's like sometimes you fix a bug and you're like, shit, I didn't even give a shit why there was a bug. It's just you fixed it. So understand, whatever happens in the markets happens. The why sometimes isn't as important as the fact that it occurred. So, pretty sure some interesting things that'll change a variety of opinions heading into sometime in 2025. And then you'll have more data to go on and be like, oh, this is interesting. Hope that helps. Christian John, where do you buy those VER NFTs? Haven't been able to find any marketplace. Was X token? Uh, X swap, X market. Oh my God. Yeah, here, open X swap. Here's your marketplace, Christian. Plenty of a market. Here's the problem. Check this out. There's no damn discounts. You go over to base. Let's see what they're selling at. 67. No, no, no. I'm not buying. So, but it's basically a dollar. Let's say 92 cents is less than a damn dollar. I'm not buying for 60 cents, 62 cents, 65 cents. Give me 20s. This better say 25 to 1. You'll never see it. So this is some stuff I'll never buy, and that's okay. I'm not buying this stuff. Now, if you see a guy throw around a $250,000 price tag, and he's slinging it at 10 cents or 15 cents, okay, fine. Maybe have an extra $250,000 lying around and take a swing. 10 cents, 15. Don't overpay. The entire point of this stream is distressed assets. Someone is crying. And that's sad from a humanitarian standpoint, but it's never personal, it's just business. Someone's selling because they have to. Someone's selling because they're desperate. Someone's selling because they don't understand. Someone's selling because they're thinking it will continue to go down, and they're going to sell before they lose everything they have. That's what you buy. When everyone has given up and it's over and dead. Hope that helps. Yeah, back to Y curve. Curve is clearly a distressed asset, which makes Y curve an extremely distressed asset. Why not buy in size? I have no need to. Manage your portfolio wisely. Manage your position size accordingly. Don't overexpose to a particular position. Portfolio composition is an art. Overexposure is critical to avoid. And serve your business well. Your purpose of your business is to not just buy. The purpose of your business is to achieve your expectations. And your expectations are most rationally set over multi-year time frames. You can't spend all your money, meaning you got X amount of capital income on a weekly basis. Are you just going to spend it all? Don't you have bills to pay? So you got to balance things. You got to balance cash on hand to service liabilities, and you got to make sure that cash on hand is of adequate size that you can acquire additional positions with reasonable size. I'm not talking in terms of DCA. I'm talking about if you can take a clip of like a damn aerodrome NFT at 8 cents, better have some capital lying around, otherwise you're not going to be able to get it. So that's why you save and accumulate, and that's why it's imperative to have cash on hand. So this all plays into a more robust capital management methodology than just compound. Where's the optionality? You just eliminated all optionality. Now, Mr. Buffett has got that bank account, baby, that is prepared for optionality. The master of optionality. The master of prudence, patience, and a master of distress assets and finding the discount. Someone is crying when Buffett is buying. Now, if you're buying a damn VE-Aero NFT at 65 cents, I find someone may be crying, but that's besides the point. But 65 cents, that's not where it needs. That's not the amount of tears that are needed, unfortunately. You need people thinking it's over. That's when you buy. And that's when you get the bang for your buck. And that's when you transform your portfolio into something that's speculatively something into something that actually has assets that are likely meaningful at appropriate size. If you're buying an asset at 62 cents compared to 8 cents, you get 6, 7, 8 times the amount of asset, amount of exposure at that cheaper price point. If you buy 10 grand of stuff at 60 cents compared to 10 cents, you would need $60,000 compared to $10,000 at 10 cents. 10 times, 6 times the amount of capital. Food for thought to acquire the same amount. You buy $10,000 worth of asset at 10 cents. To buy the same amount of asset at 60 cents, you need $60,000. So the 10,000 bought the same amount of asset as $60,000. So obviously there's multiples in there, and crypto space multiples are so easy to get in the crypto space. But the point is that that's the way it works. Cheaper price point gives you the multiple, gives you the greater position size. So there you're doing yourself the most justice, serving yourself the best. Hope that helps. Reading the Bitcoin Standard and listening to a lot of the people you talk about, Luke Lin, Raul, has really helped me swallow the orange pill. Listen, I'm fully orange pilled. I would talk with any of the Bitcoin maximalists and say, I agree. And that's exactly how I think about savings to an extent, because I do respect Forex markets, and you need to be respectful of global currency composition, because Bitcoin is merely a money, probably the best money, part of the global composition of money and currency. So the whole thing is their entire conversation is a component of a larger conversation. Because they talk about, saving Bitcoin. Yeah, what are you doing to earn income? What are you working? Do you want to work? So maybe be an investor and own business. So now your businesses are making the revenue instead of the working to make the revenue. And now we'll talk about saving because your businesses are doing the work. So business, enterprise, productivity, cash flow has nothing to do with savings. You have cash and investments. So Bitcoin narrative is cash management. It's not investment because it doesn't earn capital return. You want the capital return to be separate and apart. Generate capital now that you have a choice of what to do with. Optionality, what denomination. I choose some Bitcoin. I choose some euros. I choose some dollars. Oh, okay, great. Cash, liquid. Your choice of what the hell to do with it. Separate and apart from investing. Hope that helps you, Rex. Last question. We'll wrap it up in a little bit. If anyone has any remaining questions, happy to answer it. What's your outlook on macro and the following three? Of course, last question, you're hitting me with macro. Let's take a peek. Let's take a peek real quick. I don't care about rate cuts. They don't mean anything. It's all lagging. It's a lagging indicator. You'll see rate cuts priced into, sure, DXY, yen, not really CNH, but certainly move. You'll see rate cuts right in here. See move down at 60, 50, 40, and that's going to get very interesting. You see DXY roll over down to 90, and you're going to get that 0.25% probably real quick. So rate cuts is just old pasty white people on a board that are literally doing what a smart contract does in seconds. So all should be done on smart contracts. But it'll never happen, and it is what it is. What's the outlook on macro on the following 3 months? Rate cuts. Geopolitical pressures. Are we for some market downtrend until liquidity cycle starts? Okay, as I said, rate cuts are irrelevant. Geopolitical pressures. So, China, folks are speculating that China is having its notable effect on oil. So let's see, because of oil having some pricing in yuan. Where's my oil? Damn, 78.83. Listen, you'll see if Jeff Snyder says U.S. is at the lowest oil consumption since 2013, 2014 was his post. Very interesting. If that's the case, oil should trend downward. But that's obviously dependent on OPEC uh, and so on and so forth. It's a complicated conversation. I'm not going to end the stream digging too much into it, but oil down, and that's like cutting rates because the economy's slowing down. Dollar down. It's probably not in their best interest for the dollar to go down too much because that drives up consumer price inflation in the U.S. Weakening the dollar makes imports more expensive. A lot of pressures to consider. Pushes and pulls, knock-on effects all over the place. Mike Howell did a couple of nice conversations the last week. Probably the best expression of where we are is just the lull in the market. China is fighting a deflationary collapse, and they're trying to inflate. As they try and inflate, they're basically trying to export the deflation, which the rest of the world is going to try and fight with tariffs. But the fact is, if they're fighting a deflationary collapse, they're going to be ferociously exporting deflation that's going to seep throughout the entire system. Tariffs are only going to have a very limited effect. So how do countries fight deflation with inflation? And they usually suck at it, but the point is, that's where it's coming, and that's exactly what you're talking about. Low in the market with regard to liquidity. As China continues to export deflation, countries around the world start cascading, trying to fight deflation with inflation, which basically means, I don't know, money printer or whatever folks want to call it. Basically, liquidity incentives. It's all about incentives encouraging financial activity and productivity. That's it. So we'll end on that note. A lull in the market until countries around the world start more cutting, more cutting, more cutting, more stimulus, more stimulus, more stimulus, trying to control the deflationary part of the currency, the global currency cycle. And as it gets into the end of the year, it's inevitable that liquidity increases, particularly as U.S. has to finance its fiscal spending and refinancing cycle. And that begs to question whether we see Fed balance sheet take on the excess, or Treasury buy back the excess, because sure as hell China and Japan aren't going to be able to absorb much excess unless maybe the U.S. and Japan reach a deal with like a standing swap facility where basically Japan can print dollars and then they just turn into like a proxy for the U.S. and are able to recycle endless treasuries, and that would just be perverted to all extent. But isn't that where we are? So our job is not to be too critical of how perverted it is, because Bitcoin fixes that. Hey, look, I use the phrase Bitcoin fixes that. But to digest it, understand it, and do our best to navigate it without being like, oh my God, the system is so bad. Oh, all right, the system is stupid. It sucks. But stop complaining and be smart about it. And be rational about it. Hope that helps, ladies and gentlemen. Thank you all for joining me today. 219 people made it to the end of the stream. Monday, May 13th, 12:30 p.m. Tell everyone to subscribe. Be a little bit more rational today. Come on, come on. We can all do a little bit better together. I will see you guys later this week on a Wednesday. I will catch you next time. Peace.